business document. So we have three documents predominantly: invoice, debit note and credit note. Okay, for example, suppose the goods supplied by A to B, A being the supplier or seller and B being the buyer. For the goods sent, A needs to demand to pay, right? So for the sending a document for demanding to pay, that is called invoice. Invoice is sent by A to B and B will settle the payment later on. And B being the debtor for A. B being the debtor. In short I may write PR, debtor. B being the debtor for A. So, see here, invoice is a document demanding for payment, prepared by whom? By seller. For the amount receivables, creates receivables. Okay, in the books of seller. For seller, the amount receivable. But for the buyer, it becomes payables. Payables. Okay. Now, goods is sent for rupees 1000, demanding to pay 1000 rupees, and later on B sees, sir, out of the 1000 rupees goods you send, I don't satisfy with the 200 rupees worth of goods, I am returning that. So B simply returns the goods worth rupees 200. Now B being the debtor with respect to A to pay around 1000 rupees, because of that we have to reduce 200, right? So to reduce, what we have to do? We have to credit this. Debit to be cancelled by crediting it. So crediting. So now you have to issue the credit note. Clear? So what is called credit note? Demand to reduce the invoice value. Prepared by A seller, that reduces the receivable. What happens for the receivable here? It is created here. First time it is created. Okay. Receivable is created. First created and then decreased. Later on, it is a substandard goods, So he replaces the goods. He cancel, later on he replaces the goods. While replacing, he find that it is newly purchased one, so it cost us 300 as per the current market price. Immediately seller will demand, sir, we reduced to 200 rupees for the goods not up to the mark. I now resend a new piece. That piece worth rupees 300. Okay, for the original one. Or on inspection, we noticed one item available there without billing. Immediately A told, sir, I forgot to send this item's information. So now I need to raise further amount. So this amount also increases the amount recovered from B. Already debit. To increase, we have to debit. It increases receivables in the book, in the hands of A. So debit note document to increase the invoice value by whatever reason may be. Maybe additional supply, or the supply sent based on the old rate. Later on realize, sir, I sent with the old rate, today the rate is pretty high, sir. Anyhow, kindly consider for increasing some extra money. So that is what would increase. And it may be usually sent by either the buyer or seller. Predominantly we assume here being the seller. Okay. Increases the receivable with respect to seller's angle. And what happens with respect to buyer? It reduces this. Okay. Clear? And it becomes the payable for whose angle? It becomes payable for B, buyer. Okay. Usually it's a payable, and here payable decreases, here payable increases. So you have to understand, whatever it may be, you have to have a document for payment or raising the amount or reducing the amount. So first document for demanding for the payment is called invoice, and further the amount supposed to be increased, then credit note will be sent, debit note is sent by A. To reduce that, credit note will be sent. This is a simple document. The format is also given here, an invoice, the invoice number, and the purchasing company's name and the party's name, address, date, quantity supplied, and what quantity, unit value, everything will be given in the invoice, right? So hope you'll be now able to understand. So example scenario also given here. Okay, seller sells goods for rupees 1 lakh, invoice is prepaid. Okay, to charge buyer. Seller finds price should have been 1,10,000. After sending, only realize that the real worth is 1,10,000, not 1 lakh, because the new piece. Immediately gives an additional debit note to make him pay extra amount, price increased. And some goods worth 10,000 were damaged and returned. The supplier says, the buyer says that the goods is not up to the mark, damaged, sir, I want to return. Okay, you return, so we will now reduce the amount recoverable from him. So then it is credit note, it reduces the invoice value. Clear? Hope these are the things you have to understand. Let's say an illustration here. Invoice, credit note, and statement of account. Statement of account is nothing but a report. A transaction between A and B, no, it should be stated as the amount recoverable or payable in a report form. Financial transaction is called statement of account. Complete the table below by picking a tick to indicate which document each item appears on. The first one is completed for you. So first one is already completed. A credit purchase. Whatever it may be, credit purchase is nothing but receivable created. So invoice, and also a document for amount recoverable from the other party. So it should be appearing in the invoice as well as it will be appearing in the statement of account. Balance owing by Nazim to be supplier at the end of the month. Okay, the balance owing. Balance, it is not a transaction. So if it is not being the transaction, you don't prepare invoice, you don't prepare the credit note. But of course, it's a statement. You need to have a statement. What's the amount you're supposed to pay or what the amount you're supposed to receive from the other party will be called as statement of account. So it's only a balance. Whenever it's being the balance, it is only a statement of accounts. Purchase return. Okay. While purchasing, what happens? Okay. We might have been having a credit. So in case of debit. So while purchasing, it's debit. So while returning, you have to cancel. So you have to issue credit note. And also it affects the amount payable to the party, that will be called as statement of account. It will be adjusted there also. And trade discount deducted from list price. Trade discount will not be shown at all to be payable or receivable between the parties. So it will not come here. But of course, it may be shown in invoice, later it is adjusted. Okay. First is shown and thereafter it is adjusted. First it is debited and then it is credited. So purchases, first of all, purchases mean the party is debited, has to pay. And later on, due to the trade discount, we have to subtract that, no? So it should be credited later. Okay. So why do I want to add and subtract, sir? So adding and subtracting gives a feel. Okay. See, 1,000 rupees and where trade discount being 300 rupees, 700 is the amount payable. But anyhow, this is the original statement of account will be shown here. The amount recoverable or payable between the party being 700. What about the 1,000 and 300? It's what about the list price, the price given in the list or MRP, and 300 rupees will be the trade discount. It gives a feel to the customer that he enjoyed 300 rupees discount rather than paying full amount. Only because of that, there is no any accounting significance, so it will not be shown in the statement of account. Only in invoice, and it will be reversed in invoice itself by credit note. So the list price will be available in invoice and the trade discount will be adjusted in credit note. Payment made to credit supplier. Okay, supplier. Supplier is usually what happens. Creditor. So when we are making the payment, the amount payable to him is going to be reduced. So payment is also only what? Only a statement of account. Will not come in invoice or credit note. So invoice is nothing but amount payable or receivable increases. Credit note is the reverse case, most probably reducing. But payment or balance will be coming in the statement of account only. Okay, payment as well as balance. Okay. Payment or receipt or balance will be statement of account. So you have to be careful with this. Clear? So payment, balance, statement of account. When the transaction happens, then invoice will also be there and credit note or debit note also be there. Clear? Let me summarize this once again. Seller and buyer. Seller sends the goods and intimates him to pay amount rupees 1000 through invoice. Through invoice. So by the time, in the point of view of seller, receivable increases are created. Receivable created. And when the actual amount being 1200, not 1000. Yes says, supplier says, sir, I sent a wrong item. The new item is currently valued at rupees 1200 rupees. Kindly return, I will supply old. So the buyer says, no problem, I will have this with me. I will give that 200 rupees additionally. So seller now sends, already this will be the debit. Okay, while creating the receivable being debit. Receivable being debit. Created means debit. And now, if you want to increase or decrease, increase by how much? 200. Already debit. To increase the debit, you have to again debit. Again debit means debit note. Again debit means debit note. Here. So debit note increases the debit balance. And in case out of this 1200 rupees worth of goods, 300 rupees worth of goods seems to be unfit returned. He says, sir, goods is not worth, sir, I am returning. So as he returns the goods, now I have to subtract the amount payable, no? The balance being the debit, to subtract, what we have to do? Credit it. Credit actually reduces the amount recoverable from him. Then what about this one? 900. 300 being credit note. Okay. 300 being credit note. Now what is the amount payable by supplier to B? Initially 1000. Then after debit note 200 becomes 1200. Thereafter another 300 rupees subtracted, so 900 payable. 900 payable. In the point of view of buyer, payables. Payables means it's only credit. What document he gets for this payable? Invoice. Because of this invoice, he creates payable. Payable means credit, right? How much? 1000. Thereafter, by debit note, he gets a debit note already. For him, it's debit. For pay him, it may be credit like. It may be credit like. Okay. Further, he credits. Okay. Though it may be the debit note for the supplier, it is actually debit note received by B. Otherwise, it may be named as credit note like. But you don't need to say so. Okay. And finally, he sends the credit note for reducing the balance. The reducing balance will be debit here. Now, what is the amount B has to pay to S? Initially 1000, then becomes 1200 and becomes 900. Now, when B pays 900 rupees, what happens? You reduce 900 total to 0 and seller says you settled, you no need to pay anything. But there is no any invoice, debit note or credit note. Nothing is there. So this will be considered as statement of accounts. So the payment between these two parties will have the impact only in the final settlement amount, final settlement of account. So this will be called statement of account. Statement of account. And for the increase and decrease, invoice will be there. Apart from that, in case of trade discount, actually it's not going to be payable. As it is not going to be payable, it will not have any impact in the statement of accounts. Statement of accounts. And the trade discount will have impact only in invoice as well as credit note. Invoice and credit note means you show and you subtract. While showing, you are creating and you are not going to ask him to pay, so you are subtracting immediately by reducing it. Clear? This is the very important point. In case of trade discount, it will be shown only in invoice as well as means credit note. And the receipts and payment will be shown in the statement of account only without here. Apart from that, one more point to be noted here is all about any balance left over is nothing but amount receivable or payable is finalized between the party. Also not be involving in any invoice or debit note or credit note. So payment and balance will be appearing only in statement of account and trade discount appearing only in invoice and credit note. And invoice, debit note and credit note in the point of view of the issuer seller, invoice gives the rise to creation of the receivables, debit note increases the further receivables, credit note reduces the receivables. In the point of view B, it becomes the payable, just reverse. Is that